Hello and welcome to the Daily Gold University. This video is the first in a series of 15 to 20 educational videos which will include updated material from our new book, which we hope to finish in the next few months. Welcome to Lesson 1, which focuses on gold's fundamental drivers. Lesson 1 contains 3 videos. Gold as an investment is simple to understand, yet is muddled by the endless misinformation and disinformation from detractors and proponents alike. We often hear phrases such as end of the world trade, just a rock, flight to quality, you cannot eat gold, hedge for uncertainty, inflation hedge, deflation hedge. All of these phrases mischaracterize gold and miss the simple fact that gold is the ultimate money. Over 100 years ago, J.P. Morgan said, gold is money, everything else is credit. Gold, and secondarily silver, has lasted as money for thousands of years because it, better than anything else, fits the properties of money. It's durable, divisible, convenient, portable, uniform, and it has intrinsic value. In today's fiat world, gold is money, but more so an alternative currency that performs well when the value of fiat currencies or perceived value is declining. One way to track any currency's trend and perceived value is to compare it to the direction in real interest rates or real yields on government bonds. Over the past 100 years, the best indicator for the trend in the gold price has been the trend in real interest rates or real yields, which is essentially interest rates minus the rate of inflation. Gold will rise when real rates are negative or decline towards negative territory. Gold declines when real rates rise, and gold faces long-term headwinds when real rates are sharply positive, as they were for the majority of the 1980s and 1990s. Suppose we can earn a real inflation-adjusted return on our capital in a savings account, certificate of deposit, or government bond. In that case, there is no reason to seek alternative currencies like gold and silver. Conversely, capital moves towards alternative currencies when the inflation rate exceeds the interest rate on the securities mentioned above. First and foremost, that means gold, and secondly, silver. There are various ways to measure real interest rates. We will focus on 2. One can calculate real rates by subtracting the inflation rate using the Consumer Price Index from the federal funds rate or various bond yields. This works best in a historical and educational sense. The downside is that the Consumer Price Index or other economic statistics are backward-looking. The second way was established in the late 1990s with the advent of TIPS, or Treasury inflation-protected securities. The real yield is the difference between the government bond yield and the yield on the corresponding TIPS security. It is a market-based calculation and is fluid, as government bonds and TIPS are traded every day. We will start with the historical and educational calculation. Figure 1.1 plots gold along with the real Fed funds rate dating back to 1914. The vertical lines show the secular peaks in commodities or gold. Historical secular bull markets in gold and commodities concluded when real rates, after being in negative territory for many years, surged into positive territory. Commodity prices made secular peaks in 1920 and 1951, while gold, which was fixed in price until 1971, peaked in 1980. Commodity prices peaked in 1920 as the real Fed funds rate exploded from minus 19% to nearly 20%. Then in 1951, commodity prices peaked as the real Fed funds rate increased from minus 7% to almost 2%. From 1979 to 1980, when the gold price went parabolic and then collapsed, the real Fed funds rate increased by nearly 15%. it advanced from a low of -5% to 10%. Although the real Fed funds rate trended lower after the early 1980s, it was strongly positive for most of the 1980s and 1990s. In other words, a reduction from a sharply positive real interest rate to a modestly positive real interest rate did not move the needle with regard to gold's fundamentals. The negative correlation between the trend in the gold price and real interest rates should be particularly illuminating over the past 20 years. The real Fed funds rate declined from 3.2% in 2001 to a low of -3.7% in 2011. That decline was interrupted by a sharp but temporary rise of around 6% during the financial crisis in 2008. The gold price then declined by over 30%. While 2011 was a significant peak in gold and precious metals, it was not a true secular multi-decade peak because real interest rates only increased slightly over the next few years. But from 2011 to 2015, the real Fed funds rate rose by over 4%. That was the fundamental explanation for the 2011 to 2015 bear market. Gold surged higher in 2016 as the real Fed funds rate declined by more than 2% over an 18-month period. But gold failed to build on its 2016 gains or break out in 2017 and 2018 due to the nearly 3% rebound in real interest rates as the Federal Reserve then raised interest rates. Most recently, the real Fed funds rate crashed as a historic amount of fiscal stimulus and transfer payments, along with interest rate cuts to 0%, caused the highest inflation rate in 40 years. That all spurred gold to break the 1375 resistance level, which had held for 6 years, and reached nearly $2,100 an ounce in August 2020. However, there are some slight discrepancies over the past few years, and for an explanation, we employ real yields from the TIPS market, and specifically the real 10-year yield. Figure 1.2 shows gold and the real 10-year yield. The real Fed funds rate and real yields continued to decline after gold peaked in August 2020. How do we explain this and some other discrepancies? In figure 1.2, in the gold price, we see that gold leads real yields at important turning points. For example, gold peaked in the summer of 2011, but the real 10-year yield did not bottom until the end of 2012. Also, the gold price bottomed at the end of 2015, but real yields did not peak until 2018. Furthermore, gold peaked in August 2020 before real yields bottomed in 2021. The gold market was discounting the coming rebound in real interest rates. The opposite could be occurring at present. The real 10-year yield has surged nearly 2% since the end of 2021. But the gold price has held up very well. When the real 10-year yield surged in 2008 and 2013, gold experienced major declines. At present, gold is only off some 11% from its 2020 all-time high. Gold's relative strength is a sign that the recent rise in real yields is likely to reverse sooner rather than later. In other videos, we will discuss additional fundamental drivers for gold, but the overarching reality is the following. The U.S. and the Western world has a debt problem that can only be solved through ongoing negative real interest rates and high inflation, which will, over time, devalue interest payments to more manageable levels. Unlike in the early 1980s, the U.S. and the Western world has a huge debt problem, and the economy and financial system cannot function with positive real interest rates. In other words, the solution is to keep interest rates below the inflation rate for an extended period.